Please stay tuned for important disclosure information at the conclusion of this episode.
This is Destination Retirement with Robert Kuhn from Kuhn Capital Partners. When a part of your financial strategy is out of tune, your long-term goals, your retirement savings, and your legacy can all suffer. With many years of experience in the financial industry, Robert provides his clients and prospects the information they need regarding Social Security, retirement income planning, wealth management, and much more. Listen in as we address your financial concerns and provide helpful strategies to put you on the path to achieving your retirement goals. And now here is Destination Retirement with Robert Kuhn.
Welcome. You're listening to Destination Retirement. My name is Robert Kuhn. Thank you for joining us today. If this is your first time, welcome. Hopefully you'll find some value. Well, not hopefully. I think you will find some value if you're concerned with your current portfolio and your current income needs and how they're going to be met in retirement. We're going to provide some education on that. If you are a repeat listener or catching it on the podcast, welcome back. Thank you very much for listening. It obviously means a lot. We see the numbers. And it always seems like when the market is volatile that the daily show podcast numbers per show go up and to the right, which means we're doing something right. I think when you look at a complex and evolving retirement planning landscape, I think it's very difficult for investors to determine which strategies and tools fit ultimately their unique needs. And we're going to talk a lot about that today. The value of professional advice, I think most of the time you're paying for something that you could do on your own. If you've listened to the show, you know we've talked a lot about that. Unfortunately, most investors, their portfolios are simply tracking the market up and also tracking the market down, and that is a challenge, and people are starting to recognize that, and I like that. We believe at Kuhn Capital Partners, yes, we are a fiduciary first and foremost. We believe tactical management is a powerful, straightforward solution to navigating market volatility. We believe a disciplined, rules-based approach takes the emotion out of investing and allows us to be strategic and tactical with a stock market that does not think or feel. Very, very important. We have to make sure that we have strategies in place to protect. It's simple. If we lose less, ultimately, we're going to make more. So if you want to have a conversation this week about your particular situation, any questions you have regarding your investments, your 401k, your 457, your TSP, we certainly are here to answer those questions. So give Paige a call today, tomorrow, this week. Set some time up for us to have a conversation. 630-492-1912, 630-492-1912, and we'll certainly do our best to make sure that we can provide you answers that you are looking for. So a couple things. Obviously, the market is pretty volatile. I've never seen, and we're going to talk a lot about it this week, I've never seen, at least it's been years, and I go back 24 years in this industry, but the people who are coming out and saying that the world is in trouble, normally they don't. And it really aggravates me in this industry when advisors use fear to try to convince somebody to make change. It's something that I see happen all the time. And we don't like that. We think education is the best way to allow somebody a way to make a decision. If people are making decisions based on fear, generally they're going to regret it. When what I've found in the business and those that we work with and we talk with, and certainly our clients and those that call in from the radio show, it's simply education and how can we reduce your risk and while increasing your rate of return and create a much smoother glide path to and through retirement. And but that being said, we have to listen to what the talking heads are saying, and many very credentialed industry leaders are and have been, but are sounding the alarm. And so what that means to me is there an opportunity for a correction? I think so. I think that opportunity, could be significant. And I think a 20 to 30% correction is certainly a possibility. And the question that an advisor has to be able to answer or justify to their clients is, what are you going to do if that were to happen? And we're going to talk about two things this first segment that, I think that everybody needs to make sure that they're aware of. And that's our job. You don't know what you don't know. And strategies exist today that can mitigate risk in ways that you may find very surprising. Our job is to share those with you. And I want to be clear that when we talk about specific products, specific ideas, it's not investment advice for you. It's just a general strategy that is a real strategy that we currently are working or plan to work or have worked, but it may or may not be appropriate for you. And for some people, it could be way too aggressive. For other people, it could be way too conservative. So the point I'm getting at is, please, don't take anything or any specific product that we talk about as an indication that it's right for you. We have to talk about, could it make sense? Does it make sense? How could you utilize it inside of your portfolio? So 630-492-1912 is the phone number if you want to have that conversation, 630-492-1912. And we'll certainly, have that conversation with you. So a couple things. So if the markets do go down and they go down substantially, what's the job of an advisor? I think the job of an advisor is to make sure that you can look at somebody's portfolio and have some sort of payoff if the market does go down. And I want you to think about that. If you're investing and you're working with an advisor and they're with a big firm, a big bank, a big brokerage firm, you think they're the smartest people in the world, it's a really simple question to ask them to look at your portfolio. If the market were to go down 15 to 20 to 25, 30%, what bucket of my money, what sleeve of my portfolio would actually benefit? And I'm hesitant to say that chances are highly likely that you just don't have anything inside of your portfolio that would actually benefit or receive a payoff in a positive way if the markets were to drop. And when you look at hedging, and we talk a lot about it, and I really want you to pay attention here, the market valuations are high. I don't care what the market has done, that's irrelevant. I want to look at where the market is going to go. And we'll talk about a lot this week of some of the, most influential talking heads in the industry and some of their concerns. We'll get to that in the second segment. But right now, you have to think. You have to look at your portfolio. Okay, what will happen if the markets are down 20% in the next year, or 10% or 30%? Do I have something inside of my portfolio that will actually do well to mitigate some of that downside? So here's what we're doing. Again, I'm going to let you know, it may or may not be right for you. But when you look at the way banks hedge and their ability to hedge and protect on the downside, it's just different. It's different when you have $1 trillion balance sheet. Guys or investors with 50 million, 100 million, 200 million, they can't hedge the way a bank can hedge with $1 trillion balance sheet. And so we locked in a 15-month JP Morgan banknote that is 15 months in duration. It tracks the S&P 500 and the Russell 2000, and the cap or the max growth in 15 months is 17.70. So they'll lock in, that actually trades next week. So you still have some time to get in if you want. And it's in increments of $1,000, if you can believe that. So on July 7th, they'll lock in the closing value of the Russell 2000 and the S&P 500. And in 15 months, they'll look at it, and your maximum gain is 17.7%. So you basically get from 0 to 17.7% on the upside, okay? So obviously great growth. Here's where it gets really unique. From 0 to negative 15. So if the S&P or the Russell 2000, whichever is the least performing of the indexes, were down from 0 to negative 15, you actually get the inverse. So if the S&P from July 7th of 2020 3 to 15 months out is down 10%, your return is positive 10%. If it's down 15%, your return is positive 15%. From 0 to negative 15, you get the inverse of that. So not only are we capturing significant growth on the upside, at least the potential, at a 17.7% cap for 15 months, from 0 to negative 15, you're getting the inverse. I mean, that is so strong. I mean, talk about a hedge. That's amazing. And here's if the S&P or the Russell goes down more than 15, that's when you start to lose money. So let's say the S&P is the least performing of those two indexes, is down 20% in 15 months. Well, you're only down 5. So negative 15 is your 0. So you have a significant buffer on the downside. So if we look at where you're at today and we look at some of your equity holdings, why not consider this strategy where I don't think the S&P or the Russell is going to be up more than 17.7% in 15 months at these valuations. I'm willing to take, 0 to 17.7% as far as a max cap. Okay. But I still can make money if the market or those two indices is down. So from 0 to negative 15, I get the inverse. Think about that. The S&P or the Russell could lose 15% and you're still making 15%. And then on the downside, you have a buffer of 15%. So if the S&P or the Russell is down 20, you're only down 5. If it's down 16, you're down 1. 17, you're down 2, etc. So you think about that in incorporating those strategies, and it's backed by JP Morgan. It's a JP Morgan note. So that type of a strategy at these levels is very prudent to peel off some of your equity gains that you have and try to lock those in. And so 630-492-1912, 630-492-1912. Again, increments of $1,000. Okay, so you can do $1,000, you can do $10 million, but that's what that note is. And that's a live note. It prices next, and it trades July 7th. So that's when it locks in those values. So that's value that an advisor is bringing to the table. Okay. It's not, well, we're going to mitigate risk through diversification and all of that nonsense. It's just, you're just simply tracking the market up and down. Well, here's a way that, guess what? Most people don't realize that you can make money when the markets are down. Well, here's a strategy that the layperson can invest in. And if you look at it for 15 months and where the markets have run to, that's a great risk reward. Now, do you put all of your money in it? Absolutely not. Could it make sense for 5%, 10%, 20%, 30%? Possibly. All right. Again, we have to look at your risk tolerance. We have to look at your goals, your objectives. We have to go over the strategy. We have to send you the prospectus so you can actually take a look at it and fully understand it. But it is a great complement to locking in some gains. And so those are the kind of things that good advisory firms are bringing to the table. And that's what we're doing. So also, to finish up this segment, a lot of individuals have bought annuities. A lot of individuals have bought annuities prior to the interest rate increase. So if you bought an annuity prior to 2022, you are on the old pricing schedule. What does that mean? That means interest rates were non-existent. You know that. 10-year period, we had almost no interest rates. What does that mean for the annuities? Your growth potential could be significantly limited. Annuities today that were issued after 2000, so 2023 and beyond, their growth characteristics in many instances are 3 to 4 times what annuities who were purchased prior to 2022 were or are. So if you bought an annuity prior to 2022, let's have a conversation, because you have to compare what it was versus what it is. And there's a chance that if you already own an annuity, we could give you, or you could get a growth opportunity of 2, 3, 4x what you have, simply because of where interest rates were. Now, there's a lot of surrender charges, and people who bought annuities in the last couple of years, there's surrender charges. Well, insurance companies know this. there's opportunities to overcome them. So you bought an annuity prior to 2022. We want to have a conversation. Give Paige a call. And we're going to talk about what concerns many bright people have over the next year or two when we get back. But if you want to have a conversation, give Paige a call, 630-492-1912, 630-492-1912. More after the break.
Are you considering buying an annuity? Or did you buy an annuity because you were promised stock market-like returns with no downside? If you own the wrong annuity, there is a great chance you've experienced little to no growth over the past few years. In many instances, the insurance agent received more in commission than many have in actual investment growth. If you'd like to learn more about our annuity repair strategy, please call Robert, 800-674-3217. Again, that's 800-674-3217. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
Back, you're listening to Destination Retirement. Thank you for joining us. My name is Robert Kuhn. I am the host and founder of Kuhn Capital Partners. We're independent. We are a registered investment advisory firm. And yes, we are a fiduciary. We believe that a tactical investment management approach is the right way to do it. It's powerful. It's straightforward. When we look for solutions to navigating market volatility, we believe in a disciplined, rules-based approach. It's the best way to take the emotion out of investing, and we feel it allows us to be strategic and tactical with the stock market. And as you know, the stock market does not think or feel. We've seen so much in the market here recently. It's so range-bound, going up a little, it's going down a little. A lot of people are not making money, and they have a lot of risk given what's going on in the world. And in the first segment, we talked about a strategy. Again, it may or may not be right for you. It certainly is not investment advice for your particular situation. It is a JP Morgan bank note. That is a 15-month note, and your maximum gain over that 15-month period is 17.7%. But what makes it so unique is you can make money the inverse of the S&P or the Russell. If it were to lose up to 15%, you get the inverse of that. So if it's down 12, you get positive 12. Down 15, you get positive 15. So 630-492-1912. If you want to learn more about that, they can be bought in increments of $1,000. It is a 15-month investment. 630-492-1912. Let's talk about the pros, the cons, the risks, the rewards, and how it could or could not fit into your situation. We also talked about annuities and annuity pricing. Any annuity purchased prior to 2022 when interest rates were zero. So really from 2010 to 2022, you were on the old interest rate pricing, which is significantly lower than what they are today. Just look at what happened with interest rates last year. So if you bought an annuity prior to 2022, there's a good chance that your growth is going to be significantly hampered or mitigated compared to what is being offered today for no other reason than what happened with interest rates. So it could be the exact same strategy, the exact same plan. And in our belief, if you look at interest rates and knowing what we know about these strategies, you could increase your growth by 2, 3, 4x, at least your opportunity for growth, just simply because of the interest rates and what has happened. So strategies exist to help you overcome big penalties or big surrender charges. Again, we can certainly have a conversation about those. But if you bought an annuity prior to 2022 and you like the annuity features, let's have a conversation about those that are being issued today. And we'll talk about, the pros, the cons of considering changes and see if it's right for your situation. And really, it just becomes a math equation, and we have to make sure that you understand what it is. So 630-492-1912, 630-492-1912, and we can certainly go through that and have that conversation. When we look at obviously the market, and we look at where we're at in the market, we have to look at the potential downside, the potential risk, right? And when we look at indicators, we follow a greed indicator. And it goes from extreme fear to neutral to greed to extreme greed. And currently, we're at a reading of 77 on our greed indicator, and it is concerning. And I think it's concerning because if you look at, a lot of people want, obviously to make money. I mean, that just goes without saying, right? But I think when you look at investing, it's an emotional sport. If you look at investing, it shouldn't be a sport, but it's emotional. And there are various cycles of market emotions. And when we look at what our job is to do, our job is to make sure, as we, have talked a lot about, is if the markets are down, how can we pay off? What's my payoff in my portfolio? And the reason that we're harping on that or having, so many conversations about that recently is just because of the move in the market. And think about this. Apple's weighting. Apple has, as of this week, Apple had a 7.6% weighting in the S&P 500. That is the largest for any single company in the index going back to 1980. So are we really diversified? I mean, you have to think about that. Are we really diversified if you own index funds? So many people own index funds. And what I like to tell people when they own index funds, and now if you have under $100,000, okay, fine. I think index funds are going to give you the diversification, ultimately that you need and you want and you desire. So it's okay. But once you get to 100,000, 500,000, a million, 3 million, 4 million, 5 million, et cetera, when you look at the index funds, you have to recognize that you're going to own the good and the bad. And you have to look at where are we at in the market, and are we in an investment period or time period of the market that, we've already experienced a large loss and an index fund may be a good investment to invest in. Well, we're not in that. So when you own an index fund, you're going to own the good and the bad. And when you look at the diversification of it, as we've talked about a lot on this show, you look at the Magnificent Seven, the 7 stocks that make up almost 100% of the return of the S&P 500. So it's really not too surprising when you look at kind of, people's emotions, and you look at, people thinking that ultimately they're diversified, but they don't go under the hood, and their advisor doesn't go under the hood. And that's why when we look at, we've all seen, these charts of emotions where, you have, optimism, then you have excitement, everything is going up, and then you have thrill. Well, I got to get in. That's the buy euphoria. I can't miss out. I have to get in at all costs, throw caution to the wind. Everybody's making money. Why am I not making money? You look at, AI, the chips. I mean, everything's going up, 300, 400, 500%. So I've got to get in the market. Well, then you have anxiety, right? Did I get in at the top? And then as the markets start to sell off, you have some denial. This can't be, ultimately it's going to come back and we're going to be fine, and we're going to justify, which I think advisors are the ones that justify the most, which is troubling. Then the markets continue to drop. Then you have fear, and then you have, the markets are down another 3 to 5% or 20%. Then you have desperation. What should I do? And then the markets continue to go down. Then you have panic. And then you have I give up. And then you have hopelessness. And then you have ultimately get out. I just can't take it anymore. Get me out. And then you're sad and you have depression because now when the markets come back, ultimately you're not going to take advantage of those returns in the market. And so my concern today with many individuals is not what has happened, not where the market is at, but what's going to happen over the next 1 to 2 to 3 to 4 years. Many people are not set up correctly to protect, number one, what could happen, and number two, make money when the market gives you an opportunity. And as we talked about, at the top of each segment, in that we're tactical managers, what that means is that when you look at buy and hold, and if you consider buy and hold an investment strategy, it's simply not a good one. It is one, and it is a strategy, but it's not a good strategy. It's great for the advisor. Make no mistake, every advisor you talk to, or 99 out of 100, are going to try to convince you that buy and hold is the best way to manage money. Why is that? Well, it's because they're out getting new clients. They don't have to do a whole lot if they're just there to make you feel good once you lose 20, 30, 40% of your money. That's unfortunate. And when you look at if you're in retirement today or if you're within 5 to 10 years from retirement, that's just not a good answer. And I think I always sit back and think, what's wrong with this industry? And that's it. I mean, the fact that, who does buy and hold favor? Well, buy and hold favors Wall Street. It favors the advisor because they're getting paid no matter what. They can make you feel good when you're down 20% and convince you that you're not smart enough or they're not smart enough to manage risk. Yet, that's not a good answer. And 9 out of 10, 99 out of 100, that's who you're working with, unless you know that you're working with a tactical manager that is going to do everything they can to prevent as much of the downside as possible. So if you have a buy and hold strategy in place, my fear is if you look out 3 years, 5 years, 7 years, you're not going to be happy. So 630-492-1912, 630-492-1912. Let's certainly have a conversation, because we're talking more about losses today, really simply because the probabilities. Where everybody else was talking about losses in 2008 or 2018 or the early 2000s, that's when everybody wants to become defensive. They want to become defensive after you already lose a lot of money. I get it. Human emotions, right? Now it makes sense. Well, all you're doing is limiting the upside, because the probability, the go forward probability, isn't more to the downside. The probability is you're going to miss the upside. So we have to look at where we're at today, and we have to look at the probability. And buy and hold, it may work 80% of the time. I mean, that's good. But what about that 20% of the time that you need tactical management, that you lock in those gains, that you have cash available to participate when the markets are down? I mean, these are important things, and these are really important things always, but they're certainly important where we're at with the valuation today. So 630-492-1912 if we can help you, or you have a conversation about your current investment portfolio. Because stock market losses, if you look at it from 1928 to 2021, markets can go down. I mean, they just can go down. And if you look at what the probabilities are, if you look at just the number of years, right? I mean, you look at, a 5% or worse loss. Well, there's a 95% probability that that's going to happen in a given year. A 10% loss, well, there's a 63% probability that's going to happen. A 20% loss, well, that's a 26% probability that that's going to happen. So 30% loss in a year, it's 10% probability. 40% loss, there's a 5% probability. So let's go to that 20%. 26% probability that you're going to lose 20% in a given year. It's a really simple question. What do you have in your portfolio that can benefit from that happening? And if there wasn't meaningful options, well, then it just is what it is. You ride it out, right? I mean, there's nothing you can do, but there is something you can do. There's absolutely something you can do. And we are on a mission to make sure that we educate investors that they know there are ways to mitigate some or all of your potential losses. There are ways to make money, like we talked about with that JP Morgan note, you get the inverse from 0 to -15, you get the positive. So there are ways, there are strategies. They just not mass marketed, and they take a meeting or two to understand. That's okay with us. So we want to make sure that we're giving you the best chance to succeed. That's what the radio show's about. That's what our education is about. That's all we're about, is to let you know that things are out there before market losses happen. So 630-492-1912, 630-492-1912. Call Paige, set a call up for this week or next week, and we will do all we can to answer any of your questions. More after the break.
Would you like your portfolio to be more certain in uncertain times? These days, there are more questions than ever. Before we can get to the answers, we have a question for you. What do you want to accomplish? Understanding the bigger picture is the first step to helping you pursue your goals today, tomorrow, and for generations to come. To schedule a complimentary call with Robert, please call 800-674-3217. Again, that's 800-674-3217. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
You're listening to Destination Retirement. Thank you for joining us. My name is Robert Kuhn. I'm the president and founder of Kuhn Capital Partners. We're independent. We're a registered investment advisory firm. We believe in tactical, data-driven investment decisions, certainly when it comes to income planning, tax mitigation, and investment management. We want to make sure that everything we do is data-driven, and you know exactly if you're in retirement, when you can take more money, when you need to take less money. If you've listened to the show, you know that I think most advisors are somewhat proficient at accumulation. But when it comes to the distribution side of investing, meaning you're 5 years out from retirement or you're in retirement and you need these investments to pay you cash flow, we think that most people are doing it incorrectly, and it's not mathematical, and it's a set it and forget it. And I think people are leaving money on the table. So with that being said, any questions you have or anything thought-provoking that I share and gets you to start thinking that you want to learn more about, certainly give me a call, 630-492-1912, and set some time up with Paige for us to have a conversation, 630-492-1912, and we would be glad to share with you what we're doing and talk more about your individual situation. No question is too small either. A lot of people hesitate to call. They don't know if they have enough money. They don't know if the question is pertinent enough. And the reality is just make the call. It doesn't matter. We're here to help everybody. And we think we do. We certainly have a unique offering, and we're just going to share it. And we're going to continue to help people, hopefully, put investments in place for some of their money that can pay off if and when we see a market correction. So talked a lot this week in the first two segments about kind of all over the place, but that's just how we work here on the market. I saw a really interesting stat this week. People think the markets always go up and go up forever. And certainly they go up and to the right, but who has a 100-year time horizon? It frustrates me when advisors say two things. Number one, that the markets on average earn X. Well, okay, they do, but that's going back 100 years. So my question to you, Mr. and Mrs. Advisor, is what does that mean for your current client who may be ready to retire in 10 years or 5 years or next year or is currently in retirement? What does 100 years worth of market averages mean? Truly, it means very little, because what if we're in a period, what if you have 5 years to retirement, or you just retired, or 10 years, or you've been in retirement for a period of time? There are periods of time where the markets have had zero returns when you adjust for inflation and dividends. And everybody talks about it. We've heard it talked about. We're starting to hear a lot of people talk about it again. But you talk about the lost decade, right? The early 2000s, where the market didn't do anything, and adjusted for inflation and dividends, the market didn't do anything for 12.8 years. Yet during that period of time, it was up significantly, it was down significantly, then it was up again significantly, then it was down again significantly. But net, it didn't do anything for 12.8 years. So convince me on why a buy and hold strategy, when I can see my $1 million or my $100,000 or whatever it is, go up 100%, back down 50%, back down 75%, back up 100%. And we're not taking advantage of that. That's just a lazy way to manage money. And again, buy and hold is phenomenal for the advisor because they don't have to do anything, right? Other than convince you that it's okay to lose money when the markets are down. So we believe, again, tactical management. Times to be aggressive, times to be risk averse, and you rinse and repeat. So 12.8 years. We're just going back 20 years. September 2000 to May of 2013. If you adjust for inflation and dividends, stock market had a zero rate of return. You go back a little earlier in the 70s, 73 to 84, 11.9%, 11.9 years. no growth. 8.1 years from March of 37 to 45. You get the point. I mean, it was just a great statistic to show that there are periods of time that the markets can be down longer than you expect. And here's the challenge. They're not going straight down and staying down. And that's where I think people get confused. They're going down, they're going up, they're going down, they're going up, they're going down, they're going up. But yet, you're not getting anywhere. And so when we look at the last 10 years, and I know we talked in the first segment about a lot of what the talking heads are saying, they think these are unprecedented times. Geopolitically, they're unprecedented. Interest rates are unprecedented. I mean, they're just unprecedented. And many people believe that we pull forward 10 years worth of market gains. What does that mean? Well, for the last 10 years, the market did crazy things other than last year. I mean, 15, 17, 20% annualized rates of return depending upon what you invested in. But so many people invest in the rearview mirror. What did well it's going to continue to do well, but that it couldn't be further from the truth. So many people think that we just pulled forwarded many gains. So my fear, as we talked about in the first couple segments, is what happens if the markets over the next 3, 5, 7, 10 years, we see a lot of ups, we see a lot of downs, we see a lot of ups, we see a lot of downs, but net, we're not getting ahead. So explain to me why a buy and hold strategy, never realizing gains, never having fresh cash to put to work at lower levels when things are on sale, is the prudent investment strategy. It's not. Now, 9 out of 10 advisors are going to tell you it is because they're getting a fee. They want that fee come heck or high water. And they're going to try to convince you that the markets over 100 years do X. Those are all very true statistics. My question to you is, what does 100 years worth of data mean to you? Nothing. I mean, it truly is irrelevant. So if you have any questions, we're certainly here to talk. 630-492-1912. 630-492-1912. The remaining time we have in this segment and then in the last segment of the day, a lot of times people who call in, they want us to get more specific on the radio. If there's one suggestion I get, it's to talk more about specific products, specific strategies, etc. And I have to be careful doing that because, as I mentioned in the first segment when we talked about the JP Morgan banknote, that's not investment advice for you. That's just an investment that's out there. And I have to be able to make sure that I'm going over the pros and cons in weighting those equally, because I get tired, just like you, of hearing all the sizzle, but nothing that, the what ifs or the things in the investments that you have to be concerned about, because that's important to me. And I don't know if you're going to take this advice and go and try to implement something on your own, and it could be the right thing for you or the wrong thing for you. So, our mission at Kuhn Capital Partners has always been to help people achieve financial security. And that is different for everybody. We know that it's kind of a little cheesy tagline, right? Our job is to help you achieve financial security. Well, every advisor's job is to do that. But I know also that there's so many advisors in the industry and plans out there that everything is self-serving. And, one of them is buy and hold. I mean, buy and hold 100% of the time is not investing, in our opinion. It's great for the advisor, but it's not good for the client. We believe in buy and hold, but we also believe in tactical management. We believe in incorporating strategies, as we've talked about today, and strategies that you can actually make money when the markets are down. Those are the types of things that we want to make sure that we're bringing to the table. And so these are crazy worlds, it is a crazy world. And I think when we're looking at investing in a crazy world, today's investors are facing volatility, valuations, geopolitical risks that I haven't seen in 20 some odd years. You look at what's going on with inflation, the cost of food, gas, supply chain issues. inventory issues. I mean, some experts even say our power grid could be in jeopardy. And those are the concerns that I have. So when I am the host of Destination Retirement, my job is to bring to you strategies that ultimately I think could make up an overall portfolio. And, we look at, again, how do I invest retirement money, investment money in a crazy world? And some say to simply put all of your retirement money in stocks, bonds, mutual funds, precious metals, cryptocurrency, and diversify it out and then hope that in 3, 5, 7, 10 years from now, it's going to be higher. Well, I just told you how inflation adjusted for dividends, how the S&P was flat for 13 years from 2000 to 2013. Another statistic that we talk an awful lot about on the radio is that had you bought Microsoft in 2000, it took you 14 years just to get back to even. We're in that type of a market today that people, in my opinion, need to recognize now's the time to lock some gains in, put it in something that has some sort of a mitigation factor in place on the downside. We're not saying put it in a CD. We're not saying put it into a money market. We're saying we still want upside growth, but we want to make sure that somehow we're putting it into some sort of investment that gives us some mitigation, on the downside, because there is risk. And in a volatile economy and a volatile stock market, it's a very difficult situation to be in when investors are trying to grow your investments in a portfolio and then also create and live on income throughout retirement. And I just don't think the industry has done a good enough job of explaining just the basics when it comes to investing. We look at Black Tuesday, we look at the .com, we look at the global financial crisis, we look at COVID. I mean, we're not going back to the, Great Depression here. I mean, we just are going back 23, 24 years. And you look at the stimulus and you look at how easy it has been to make money. Well, what if it's not anymore? And those are the things that I want to get across. And those are the things that, candidly, I'm passionate about. I don't like, or I have an issue with basic advice. I have an issue with buy and hold only. I mean, buy and hold's great. But what about the tactical side? What about when we need to be conservative? What about when we need to be risk averse? What about when we need to generate cash to make sure that we have capital to buy things when they're on sale? I mean, so yeah, I am very passionate about bad financial advice, and it's all out there. And I mean, you see it, I see it all over the place. And if you've talked with us, our job isn't to talk you into doing things. Our job is to educate you, because I only want to work with people who want help, period. End of story. There's so many people in the Chicago market and nationally that we can help, that need help and want our help, that I just don't want to waste my time on trying to convince people what you're doing is wrong. If you believe what you're doing is right, even though I know it's wrong, well, it's your money, and I respect that. And then we're going to go on to somebody who recognizes that they have an issue, and we're here to help. So when we come back, we're going to talk about the 3 very basics. If you do nothing else, with your money, we're going to talk about 3 things in the last segment that you have to make sure that you're going to do. You want to have a conversation with myself, give Paige a call, 630-492-1912. She will set that time up for us to have a conversation, 630-492-1912. More after the break.
Hoping is good. Knowing is better. You are unique, and your investments and plans should reflect that. Investors today want defined outcomes, not investments that simply track the stock market up and down. Did you know most of all mutual funds and managed accounts by prospectus must stay fully invested no matter how good or bad the stock market is? There is a better way. We want our clients to use portfolio gains to compound their investments, not make up for portfolio losses. Schedule a complimentary call with Robert. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
You're listening to Destination Retirement. I am Robert Kuhn. I'm the host and founder of Kuhn Capital Partners. We're an independent, registered investment advisory firm. And yes, we are a fiduciary. We believe in a data-driven process that incorporates buy and hold, tactical management, active management, passive investments, active investments. There's a time and place for everything. But here's what I know. As we talked a lot about today, I want to make sure that you know that there are strategies in place that we can put in place for you that can mitigate some downside. All of it, some of it, etc. So you want to have a conversation about tax mitigation, portfolio stress testing, income maximization. You just want to have a question about your 401k, your TSP, your whatever. If it has to do with money or sports, but if it has to do with money specifically, sports second, give us a call, 630-492-1912. And Paige will set that time up for us to have a call this week, 630-492-1912. Okay, recap of the show. So, talked about the JP Morgan bank note. Again, very interesting. It's only 15 months. Good upside. Cap is 17.70% growth potential on the upside. The big key here is from 0 to negative 15. You actually get the inverse. So a way to make money if the markets go down, and you have a 15% buffer on the downside. So if the S&P or the Russell were down 20% in 15 months, you're only down 5. So very compelling to take some of your equity money and shift it over to that strategy, just simply because of where the market is today. So give us a call if you want to learn more about that. I want to get you the prospectus so you can take a look at that, 630-492-1912. Talked about annuities, and obviously people love annuities because of the fact that they can't lose money. Unfortunately, many don't grow as well either, at least not meaningfully. Especially, we use a very targeted niche strategy that is a index annuity that we have found to be the greatest growth strategy out there for annuities. So, but take it a little deeper. If you have purchased an annuity prior to 2022, so really between 2010 to 2022. You were on, and the investment was based upon an interest rate environment of near zero, which is going to simply reduce the growth. It's just mathematical hedging, and it just is what it is. But if you did buy an annuity prior to 2022, let's have a conversation. Allow us to review it. Let's go over exactly mathematically what would be needed, and we can recommend should you make a change or should you not make a change. 630-492-1912, 630-492-1912. And you know what, with interest rates being where there are, anybody who owns a variable annuity, those are expensive 3 to 5% a year. So if you own a variable annuity, we have to talk. Being a registered investment advisory firm and fiduciary, we can use a annuity that is completely liquid, that only cost our management fee and $20 a month. And sometimes there's embedded fund costs, but we just have to go over that. But we could, if you own a variable annuity, first off, why? I mean, they're just not anywhere near as popular as they once were, but they're so expensive. And, they have these fictitious guaranteed gains. Nobody's guaranteeing your real money at the 5 to 7% growth rate. It just doesn't happen, but I'm sure that's what you heard. But if you own a variable annuity, let's talk about drastically cutting the expenses and, still having it in the tax deferral state. But we can, in a lot of instances, cut your tax or your costs and your expense significantly. And even for high wage earners who have maxed out all of their tax deferred assets, a fee-based variable annuity could make some sense because A, it's incredibly cheap, and B, your money's growing tax deferred. So I think you're going to start seeing the variable annuity space, especially where we think tax rates are going to go, which is up. We think that it's going to come back where you just want a simple annuity that is dirt cheap, is completely liquid, and you're getting the tax deferral each and every year. So you're not paying taxes on those gains. Those gains are deferred until you take withdrawals. So certainly something to think about. 630-492-1912. Okay, so we talked about in the last few minutes here 3 things that we have to focus on. We're going bare bones here, very, very basic. I always ask people, if you could, and if you're going to call in, think about this. What if you could design your perfect investment? What does it look like? That helps me understand what you're looking for. And a lot of times people don't realize that their perfect investment exists. You just have to have an advisor that can be open and not pigeonhole every investor into A, B, and C strategy, because it's ultimately your money. So when we invest, we have to make sure that we think about safety. As you know, Warren Buffett, CEO of Berkshire Hathaway, one of the wealthiest people in the world, he states the number 1 rule for investing is never lose money. The second rule, never forget rule number 1. It's hard. We are hardwired to seek security as human beings. It just is, especially as we get older. We just don't have the time to recoup from potential losses. So I want to ask you, what inside your portfolio will have a positive payoff if the markets go down 20 or 30% or 10% or 5%? If you don't have it, we have to talk. Newsflash, diversification does not equal safety. Because most people, even if you own 10, 15, 20 different investments, you own 2 things. You own stocks, you own bonds, and that's it, equities and bonds. So we have to make sure that we're not forgetting about safety of principle. Simple math, markets down 30, you have to do 43% the following year just to get back to even. Markets down 20, you have to do 25%. Markets down 40, you have to do 67%. If you're in your 20s or 30s, while I don't think that's the way you should manage money, you can overcome it a lot of times, but if you're in your 50s, 60s, and 70s, we certainly need to make sure that we're being cognizant of the what ifs. We have to grow your money. It's number 2, grow your money. We know the importance of protecting your hard-earned investments is vital, and now we have to grow it. You want to make sure that you're looking for a reasonable rate of return that has some sort of ability to mitigate downside. That's it. All right. So when we invest our money, we want to make sure that we have good growth opportunities, but we have something inside of a portfolio that will pay off positively if the markets do go down or down significantly or even down a little. And then number 3, you want to keep it simple, right? I mean, but don't hear that as just stocks and bonds. I mean, the JP Morgan note we talked about, it's not a simple product or solution. It's simple once you do it once, but our job is not to lay out a 200-page pitch deck to make us look important. Our job is to bring you institutional type strategies that have some sort of risk mitigation in place that is not foregoing significant upside opportunity. So that's it. We're going to stick with it. We keep doing it. If you want to have a conversation with us, we are starting educational workshops in the fall. We're excited about that. More to come on that. But if you want to have a conversation about your current portfolio, concerns, tax mitigation, you want to stress test your current portfolio, you want to talk about maximizing your income, give us a call, 630-492-1912, 630-492-1912. Make it a great week.
Thank you for listening to Destination Retirement. Don't pay too much for taxes or retire without a sound retirement plan. For more information, please contact Robert Kuhn from Kuhn Capital Partners. Call 630-492-1912 or visit them online at kuhncp.com.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guests unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.